Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about whether housing permits are flagging a recession. And we're also going to talk about what is going on with Pulte and Trump going after Fed governors. So it's going to be a great episode. First, I want to say thank you to our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here live. And first thing we have to do, come on.
Okay.
Paper, rock, scissors. Oh, okay. First one goes to me. Yes, we have a lot to talk about. Of course, yesterday's housing starts report. Starts in itself did beat estimates. Very volatile data line, especially when it's multifamily pushing it. But housing permits are at a cycle low. So I think, like we talked about previously, went on CNBC and talked about, well, what's going on here? And same theme as always, the builders can sell homes when mortgage rates get closer to 6%. We saw this in the new home sales application that was positive, and mortgage rates are just a tad lower than that period in July. So it's a very complicated economic cycle. I know all my Wall Street friends are asking what's going on. And the honest truth is that the builders' labor is very limited to a degree. And if they do have a lot of homes that are still in construction and a lot of homes waiting to start construction, if mortgage rates do go to 6%, they want to make sure that they do not lose that labor to keep things going. It's very different than previous economic cycles, other previous economic cycles, housing permits, multifamily permits, starts, they would all fall together and then labor breaks. We're already seeing 4 months of labor decline in the residential construction workers. We're seeing specialty contract trade workers already roll over from sometimes. We put that in the chart. Historically, that's never a good sign for the economic cycle. But permits being this low really means that there's not a lot of wiggle room left. If rates, let's say hypothetically, went up to 7.25% and 7.5%, and new home sales fell even more, if you breach under that 2022 low, things just get worse. So all the wiggle room that we have had for 14 years, by the way, it isn't just post-COVID, with the builders and completed units, everything is hit that threshold. And it's not shocking that the last 3 months has the lowest job growth on average, really in the 21st century, if you don't have a negative report. And residential constructions are rolling over, especially construction labor's rolling over, and manufacturing jobs are rolling over. So there's a lot of things here on the labor side. And can AI really save the growth in the economy? Of course, data centers are being built in a very accelerated rate. We haven't had that happen in our history. So that's keeping the total construction data from looking worse. But it's such a unique cycle in that way, because if you ran previous economic models, you would say, why are the builders aren't firing people? But there are tangible variables that are very unique. We've written about it many times to try to explain it, but housing permits being at a cycle, not a positive.
So this is really key to your economic work and something we're looking at, which is when residential construction workers lose their jobs, that is one of the keys for the housing, not just the housing market, for the economy to go into a recession. But I do think it's weird with the data centers and some of the other construction going on. Does that throw off that key variable?
It does on the total construction side, but we're seeing not only residential permits roll over, obviously office space construction has been rolling over for some time. The AI data centers are keeping it. I mean, really, Mark Zuckerberg from Facebook is putting in a lot of money into the U.S. economy. So a few companies are shelling out a lot of dollars that we haven't had. And also, I know a lot of nerdy people talk about deficits are so much larger now than you would see in a traditional cycle. It's just because mandatory payments are so much larger. We have a lot of people that are getting checks, right? Yep. Social Security checks. So it's a very unique cycle in that front. A lot of people say, can you possibly even have a recession with deficits? Because when you inject money into economy, it's in a positive, right? And you're not going to necessarily shut down Social Security or Medicare or anything like that. So it is intriguing, but I'm just going to go back to what I said. if we've had the worst 3 job month growth, and a lot of people say, well, it's population growth is slow and we can't. This is not it. Jobless, continuing claims are at a 3-year high. You don't traditionally want to see manufacturing and residential jobs fall. That's not been the case in the previous 14 years, but for the first time, this is happening. So we show it the respects and we keep an eye on it. But new home sales still haven't breached below 2022 levels. They've been in a sales range, as I talked about on CNBC, since really 2018, 2019. We've just been hovering back and forth. Whenever rates go up, sales go down. Whenever rates go down to 6%, I know it's really weird, but that channel and sales data has been key. And the builders aren't going to really let go of that labor, especially with the homes they have ready to start and good to go. So very unique cycle in that front.
Very unique. So just one more question about the recession. What else are you looking at that you're like, we need to keep an eye on this when you look at your recession red flags?
The number one thing since late 2022, jobless claims, 4-week moving average has to head toward 323,000. If you look at the history of economic cycles in the US and you tie it to the civilian labor force, there's a certain percentage. This gets really nerdy, Sarah. I don't even want to put those charts up there because they're so nerdy, but there's a certain percentage that jobless claims and continuing claims rise together that has been part of every single recession post World War II. So in 2022, things were low enough to where I could say, listen, we got to get to here. Don't go into the recession talk until that happens. And jobless claims, every year it has a seasonal increase in rise, but it's never broken toward that 323 4-week moving average. Now it's a little bit unique because population growth has slowed down, immigration has slowed down, but that's not what's going on with the jobs report. So unless we get some positive revisions, none of this is good. And I know a lot of people say, well, a lot of people who don't want the Fed to cut rates because they hate everything and they want to see everything break. They were so trained to believe that Fed rate hikes would destroy not only the stock market, by the way, all you stock traders, you're embarrassing yourselves for all the terrible calls you've had for the last 3, 4, 5 years. And no shame, by the way, with your doom porn websites. This is why we do not listen to middle-aged men podcast stock traders on anything. I just had to let that out.
Good rant. Good.
And also, the U.S. consumer is in such better shape than anyone ever understands. And everyone keeps on highlighting credit card debt is rising. Just give it a rest, guys. It's like 4 years now. Every recession theory has been based on credit card expanding. That's been a function of every economic cycle growth, right? So here we are. Qualified mortgage came in 2010. The 2005 bankruptcy reforms laws. Any analyst listening to this right now, you go verse yourself on those 2 laws. They changed the structure of the U.S. economy for this century. If you're not versed with those 2 laws, then you wouldn't understand why consumption data has been holding up, even with the Fed rate hikes, even with the 10-year yield going up, even with the credit card delinquencies and auto loan delinquencies. The structural whole of the middle and upper middle class that do a lot of the spending out here are not in that category group. Qualified mortgage and the bankruptcy reform laws changed everything. And that could explain why things are holding up. But with that said, you don't want to see a 3-month average of 35,000. If it's 78 to 133,000, yes. I mean, I would be out here saying, hey, listen, tie it to the labor force. That looks about right. But that's not what's occurring right now.
You know, we do have that one other variable, which I know you have felt like the federal job loss has not move the picture at all, come into the picture at all. But a lot of those people have been being paid through the end of September. So I feel like October numbers, maybe we see some impact there because you have a lot of people who are being paid through September who it's really uncertain right now. Are they working? Are they not working? How many people are there? There's all those court cases. But I feel like at the end of September, that will stop. So October numbers are going to be interesting.
You can get job losses due to that, but like we've always said, we have over 162 million people working.
It's true.
The federal workers are a very small sliver of that workforce. So it could impact it. But when we think about economic recessions, what happens is consumption starts to fall and the aggregate growth starts to slow down. And then you see natural layoffs because corporations have to protect their profit margins out there. That's not been the case. There's a lot of things you could keep an eye on going out for the rest of the year as we import more stuff what's going to happen? Are corporate profits going to fall because the companies eat it? Or are they going to raise prices and some companies just can't pass on? There's things to look at. Federal workers is not going to be big enough in the big scale. And, they have enough time to kind of sit and think about where they want to go. But again, I'm just trained to believe that you do not want to see manufacturing jobs lost and residential construction jobs lost together. Now, industrial production data has been holding up fairly well in that, but there are things that we naturally see break in a recession. They're not quite here yet. And we talked about this a few months ago. What if you had 40 to 60,000 jobs created for 4 years, but no layoffs? I mean, it's a very, very slow job growth, but technically, if there's not layoffs, that means the consumption data is holding up. So we keep a track of those things. But again, this is a very, very unique cycle. And we're in a period in time where we have a lot of attention given to a few really bad actors out there who keep on saying recession and crashes and everything, and they get highlighted for doom porn. This is why we do challenges and live debates, and we force these people, by the way, 99.9% of the people run, but teaching this, we could explain what's going on here, but we're at a different stage of the economic cycle for sure.
Okay, well, speaking of very unusual things happening, just today we have Pam Bondi, head of the DOJ, saying that she's going to go after one of the Fed governors. So this is really unusual. We also have Bill Pulte, FHFA director, calling this out. So this is part of a larger strategy that we have talked about now for, what is it, like 6 weeks ago? You were talking about how, if Trump wants to change the Fed, the thing he has to do, it's not just Powell, it's the governor. So how do you see what happened today?
What do we say? Was it 5-6 weeks ago? Prepare for Fed governor assaults.
Yeah.
They're going to pick stuff out. There's stuff out there that they can go after, and you're going to see a wave, because if you want to neutralize the Fed, right? All I'm doing is reading the guy and what the game plan is here. You can find skeletons out there, and then you try to inflict as much pain as you possibly can, because if you lose more governors, you can put more of your people in, and that neutralizes Powell. Powell's going to be gone anyway, but whoever's the next Fed chair, if you got your own people in there, I mean, there are people that would say that's not going to work, the market's going to, but again, 65 to 75% of where the 10-year yield and 30-year mortgage rate is still kind of Fed policy. I tweeted out this morning, I said, even though Bostic, I don't believe is a voting member anymore, he's been slightly hawkish. They are probably going to go after him next. You neutralize your enemies, and that's how you have to look at it. I know it's not conventional, but if you play New York bully ball, this kind of mob boss attitude, this is how you do it. You go after these people, and that's why we said it 6 weeks ago, I think, where we said, look for Fed governors to be the next target, because it's a chess game, right? There's pieces out here. If you got more of your Fed people in that are going to be chairman and more voters, you neutralize this. And also, it leaves kind of a bad taste in your mouth. Do you really want to be a Fed governor?
Right.
In this environment. So I think when Colger retired early, I mean, she was planning to leave in January, there's, again, people are human, right? Everyone deals with things in a different way. And I think in this case, trying to put pressure on people to try to get them to resign, to put your own people, whatever, even if you disagree with it, as an analyst, I don't care, agree or disagree. All I have to do is see how the game plan is going to be met. And this is why we brought this up 6 weeks ago. This is why we also brought the shadow Fed boxing technique about, let's just put all these candidates out there and see which one of them are going to go out in public and say, we want for lower rates.
Yeah.
Right. They're all going to be Fed chairmen, whatever. That's not the case. You don't know. But they're trying to get more people to say things publicly. And again, this is all going after Jerome Powell. Neutralize him. When he leaves his own person in, you get more pieces to the puzzle on your side. Agree or disagree, that was how the game plan should have been viewed a while back.
I also think that, to your point, people are people. I don't think that Fed governors are probably used to this. Very few people would be used to this kind of intimidation. You're a Fed governor. I mean, that's not really what you signed up for.
No, but this is the world we live in, and elections have consequences, and people should have kind of, when we brought the shadow Fed president theory, I remember we were talking about this November, December, that
Right.
there's gonna be changes here, because what does the White House want? The Trinity effect. We talked about November 7th, the day after, and we said lower dollar, check. Lower energy prices, check. Lower mortgage rates. That's the thing. So if the mortgage rates were down at 6% and home sales are growing, why? Because whatever happens with tariffs, if prices do go up and inflation go up, let's mind ourselves that core CPI is 3.1%, not at 2%. The PPI inflation, very volatile data line. It is also hot. Trump and his White House teams believes that they can win if energy prices are lower and if mortgage rates are lower. Why? Lower gas prices. Everyone's in their minds are thinking, hey, lower gas prices, good. Lower mortgage rates, right? It's the third calendar year of the lowest home sales ever. You're not talking about 3, 4, 5. I know Trump is talking about emergency rate cuts. That's not going to happen. It doesn't matter how many people that he puts into the Fed. But in any case, it changed the economic landscape for normal people to play less in gas and less in mortgage. And in the sense, he believes that general thing wins. Even if corporate profits have to go down, they'll put it Main Street versus Wall Street. This is a tactical plan that was starting in, and it just, the last piece of the puzzle is the one that's holding it back.
So, and unlike when he floated the idea of like, hey, I'm just going to fire Jerome Powell, the Fed chair, markets did not like that. He got a lot of pushback on that. It feels like what he's doing with the Fed governors isn't really having an effect on the market in a bad way, in a negative way.
Where the 10-year yield is today, it looks perfectly normal with Fed policy, where inflation's right. There's nothing, and we've been talking about that. If you actually look at the last few years, waves and channels, right? We don't ever target mortgage rates here. We target the 10-year yield and where Fed policy is and where the economy is, nominal growth, inflation expectations. There's nothing abnormal with where the 10-year yield is right now. Mortgage rates were slightly higher than normal because the mortgage spreads were bad. That has gotten better now. So again, at this point, you're only talking about 0.5%.
Yeah.
I mean, I cannot go below 5.75, just because of everything, pet policy and inflation, unless there's a recession happening. If a recession happens, the Fed goes into another. We've never talked about an accommodative stance with the Federal Reserve because they've never brought it up. Everything was about getting to neutral policy. Neutral policy for everyone is different. Of course, my take always been I would have never raised the Fed funds rate above 4% because the disinflation from global pandemics are very historically known. Now you have the tariffs and trade war and everything. And once the Fed raised its inflation expectations due to tariffs, that was war. And that's how Trump looks at it. It's a declaration of war, Powell versus Trump. And here we are almost in September, and now they're going after governors, right? And this is how you try to do a war. You have to take out the pieces out and put your people in. And it's a numbers game out here. So this is not the last. I wouldn't be surprised if Bostic, Atlanta Fed president, is next. There are skeletons there that they can go after if they wanted to. Well,
we'll be, this is a national podcast. What are you talking about there? Because that sounds very ominous.
No, I mean, there's a lot of Fed people. I mean, some of them have been reprimanded for their trading and investments over the years. So Bostic is somebody that, has not been extremely dovish. And it wouldn't shock me. I mean, I wouldn't put that on a tweet out here to say that he might be next on the list. If they're going after Lisa Cook for mortgages, boy, there's other things. So again, it's some of it is optics. Some of it is, hey, listen, we want our people in. You're not one of us. So this is how the man operates. We deal with what we can as analysts. We just have to function. But to me, again, the economic data matters more than all of this. And we run off of that first before any of the Fed governors or Fed presidents and chairman stuff.
On our next podcast, we will be talking about the Jackson Hole meeting, what you're looking for there. That happens on Friday, so that's going to be very key to what happens next. Just give us a preview. You expecting anything big from Powell?
Powell can do something really funny if he really wanted to. Knowing traditional Powell, he might just highlight that, the jobs data might be something he's a little bit more cautious about. Mind that I truly believe if the Federal Reserve had those jobs numbers in front of them and they were reported that way, you would have already seen a cut. Why do I say that? Because last year, Jerome Powell admitted that they waited too long, and then the negative revisions forced them to cut 50 basis points. The funny thing is that, the Trump White House is talking about, firing the BLS for the negative revisions, but the negative revisions were happening during Biden's administration, and now they're happening here, which is a common trend in that. But if you want lower rates, it's really the labor data. So in a sense,
you need the negative revisions, probably, correct?
If that's what you were going for, you had a case now. Data gets very interesting in that light. But does Powell just basically say, hey, listen, last year job growth got toward 160, 170,000. That was lower than what we were working off from. The last 3 months is 35,000. I mean, on average, that's different. That is a severe decline. Even 2 months ago, I even said for the first time, my economic work, the labor data is underperforming, right? And it would be interesting. I want to see what he says about that, because that's the biggest shift miss in labor data that, to my knowledge, Powell has ever dealt with. Because if it was 133,000, even if it was 80 to 85,000 jobs per month, that would be, maybe they could say it's just population growth. There's nothing. That's not happening. You don't have manufacturing jobs being lost and residential jobs being lost and this much job growth slowing down that much and just say the labor market is strong. Sarah Wheeler, the labor market is strong. This is the lowest job growth. Right. Continuing claims are at three-year highs, and manufacturing and residential jobs. Something is wrong there on the Federal Reserve sides on the labor data pool. And you have more Fed presidents who are now saying, well, this is all just population and immigration growth. I don't know why they've broken from historical data line pools. And we said, they're going to probably do a lot of phone calls, right? We did a whole podcast, the thing about this, that the Fed doesn't so much trust the data. And I'm assuming that their phone calls didn't get the answers that the labor data is showing. And I think that's the miss, that's the connection miss, because they would have cut rates if they knew job growth has gone down to 35,000. And that didn't happen. So my whole thing is, what does Powell say? Because that's not a oops. That is a big oops. And they've been doing phone calls. So if they say, hey, listen, our phone calls with people, no one's laying off anyone, that's why we're staying here. Okay, at least that's a legitimate claim. But if they can say, hey, listen, our phone calls, nobody's hiring, but now we're going to have to be a little bit more careful with labor. That to me is probably the most plausible, because that was just to go from his kind of hawkish tone in the Fed presser to, oh God, boy, that's a big whisk. That reminds me a lot of 2024, except this is a much extreme case.
Totally agree. Okay, well, we are out of time. Thank you so much for being here in the studio. This is so fun to have it live, or I guess not live, but like in person. Great to have you on. We will talk to you again soon.
Pleasure. One more time. Paper, rock, scissors.
Okay, but you have to go 1, 2, 3, and then on the fourth one you do it. Okay. Okay. 1, 2, 3. Oh,
yes,
I won. Okay.
No, we're even now. We'll continue.
I won. Some other time. Let's just talk about I won.
By the way, for those who don't understand, paper, rock, scissors, labor over inflation. The growth rate of inflation fell. Mortgage rates never got below 6% because Fed policy is up here. Inflation was down there. They told you they were going to stay restrictive. That's why mortgage rates are still elevated, because 65 to 75% of this is still Fed policy.
Also, I won. Let's not forget that. All right. Thank you, Logan.